Investing and financing cash flows are essential components of the statement of cash flows because they explain how a company allocates capital and finances its operations. The program explains that the cash flow statement divides cash movements into operating, investing, and financing activities to help analysts assess liquidity, solvency, and financial flexibility. Investing activities involve acquiring and disposing of long-term assets and investments, while financing activities relate to obtaining or repaying capital from creditors and shareholders. Together, these sections provide insight into management's strategic decisions regarding expansion, capital structure, and shareholder returns. Analysts evaluate these cash flows carefully because they reveal how a company funds growth and sustains long-term operations beyond reported accounting earnings. Investing cash flows primarily involve transactions related to long-term assets and investment securities. Common investing cash outflows include purchases of property, plant and equipment, acquisitions of subsidiaries, and investments in debt or equity securities. Cash inflows arise from selling fixed assets, disposing of investments, or collecting principal from loans made to other entities. Large capital expenditures may indicate expansion and future growth opportunities, while asset sales could reflect restructuring or liquidity needs. Analysts examine investing cash flows to assess whether a company is investing sufficiently to maintain competitiveness and operational efficiency. Persistent negative investing cash flow is not necessarily unfavorable if investments are expected to generate strong future returns and support sustainable long-term profitability. Financing cash flows reflect transactions with creditors and shareholders that affect the company's capital structure. Financing inflows include issuing debt, borrowing from financial institutions, or issuing new shares. Financing outflows include repaying debt, repurchasing shares, and paying dividends to shareholders. Analysts use financing cash flow analysis to evaluate how companies fund operations and manage leverage. A company heavily dependent on external financing may face greater financial risk during economic downturns or periods of rising interest rates. Conversely, firms generating strong operating cash flow may rely less on borrowing and maintain greater financial flexibility. Financing activities therefore provide important insight into liquidity management, solvency, and management's long-term capital allocation strategy. The program highlights important classification differences between IFRS and US GAAP in the statement of cash flows. Under US GAAP, interest paid and interest received are classified as operating cash flows, while dividends received are operating activities and dividends paid are financing activities. IFRS provides greater flexibility by allowing interest and dividends received or paid to be classified as either operating, investing, or financing activities depending on the nature of the transaction and company policy. These classification differences can significantly affect reported operating cash flow and key financial ratios. Analysts comparing international firms must therefore adjust for accounting differences to ensure meaningful analysis and avoid drawing inaccurate conclusions regarding operating performance or liquidity. Differences between IFRS and US GAAP also affect the interpretation of cash flow quality and financial ratios. Because IFRS permits greater classification flexibility, companies may choose classifications that improve reported operating cash flow and strengthen liquidity measures. For example, classifying interest paid as financing rather than operating activity under IFRS increases reported operating cash flow compared with US GAAP treatment. Analysts must therefore examine disclosures carefully and understand the underlying accounting policies used by firms. Consistent adjustments are often necessary when comparing multinational companies across jurisdictions. Understanding these differences is essential for evaluating earnings quality, forecasting future cash generation, and accurately assessing financial strength within global capital markets. The analysis of investing and financing cash flows provides valuable insight into a company's strategic priorities, growth prospects, and financial sustainability. Strong operating cash flow combined with prudent investing and financing decisions generally indicates sound financial management and long-term stability. In contrast, excessive reliance on debt financing or weak investment discipline may increase financial risk and reduce future flexibility. Analysts integrate investing and financing cash flow analysis with profitability, leverage, and liquidity measures to evaluate overall corporate health. A strong understanding of IFRS and US GAAP cash flow classification differences further improves cross-border comparability and analytical accuracy. These skills enable finance professionals to assess business sustainability, valuation potential, and long-term investment attractiveness more effectively.